In the past, crypto followed quite predictable patterns. We had our price rally that generated a lot of attention. Many new people entered the space, and the number of short-term holders, the number of people that just wanted to jump on the bandwagon, rose very quickly. And so over time, as the rally continued, the Bitcoin that was held by short-term holders went up, the Bitcoin that was held by long-term holders went down. The long-term holders here are in blue, the short-term holders are in red. This kind of shift in the ownership did have an impact on the price development, because as more and more Bitcoin is held by short-term holders, those people don't necessarily know what to do with the volatility, right? With the ups and downs in the price. If the price just goes down another 10 or 20%, the short-term holders are very confused. They're very nervous. They might sell low because they don't know how much lower it can go. They just bought in the middle of a rally and they think that that rally continues. So for example, over here, in 2018, a lot of Bitcoin was held by the short-term holders. The red area is rather extended. Then as the rally stopped, the short-term holders exited the market. And it was mainly the long-term holders, the dollar cost averagers, the people that buy into crypto all the time, that took over. We've seen a very similar effect in 2021. Again, our run up of Bitcoin from 5K all the way to above 60K. Again, the long-term holders sold, the short-term holders took over. And as the market cooled off, long-term holders took over. When the majority of Bitcoin is held by the long-term holders, we tend to have a stable price floor, because the long-term holders tend to only sell when we reach new all-time highs. The reason why long-term holders are long-term holders is because they can ride through the volatility, and the only reason to sell is to potentially rebalance a portfolio. So let's say you get into Bitcoin just as another asset class. You already have stocks, you already have property, you also have Bitcoin now, you're investing for the long term, you maybe put 10% of your net worth in the asset. If then the asset goes up by 2, 3, 4, 5x, you might then of course rebalance, right? Because you don't want to have 40 or 50% of your net worth in that single asset class, especially after such a rally. That's when the long-term holders sell. Historically, it was always the best time to sell when the short-term holders owned a lot of the Bitcoin, and it was the best time to buy when the long-term holders tended to be in losses. So let's take away the short-term holders here. Let's just look at the long-term holders. We've got two color shades here. We've got light blue and dark blue. Light blue is the long-term holder supply that's in loss. Dark blue is the long-term holder supply that's in profit. When the long-term holders are in profit, or at least some of them are, that's a good time to buy. Now, instead of looking at the Bitcoin supply like this, we can also normalize this to 100%. Then we get this chart here. We see that over the years, more and more Bitcoin tends to be held by the long-term holders. This is going up from maybe 60% of the supply to now 80%. But we also observe an interesting pattern. Whenever the long-term holders had a lot of the supply, at the same time, a good fraction of them tended to be in losses as well. So the long-term holders simply just keep on holding during the bear market. There were not so many times in the past where a lot of the supply was held by the long-term holders, and at the same time, there are very few losses. We had this over here once in October of 2021. This did not play out too well. But we also had this here in March of 2017. This did play out well for the price afterwards. Currently, we are exactly at that point. A lot of the supply is held by the long-term holders, and they are not in losses. Now, there is this idea of the 4-year cycle in Bitcoin. Because Bitcoin's newly issued supply gets cut in half every 4 years, the idea is that the price also might correlate with a 4-year cycle. And historically, this has been the case. Will it be like this in the future as well? Of course, nobody has a crystal ball. What is interesting, though, is to see the percent of the supply that was in losses at the end of each bear market. We tended to go from top to bottom to more than 50% in losses. In the current cycle, we haven't seen such a drastic drop yet. This chart shows how much of the short-term holder wealth is currently in profit or in loss. When this is red, we should potentially short-term buy. When this is not red, we might potentially sell. The current price always hovers around the short-term holder cost basis, and currently that is at 99K. Of course, we can also smoothen this out, and that's my preferred way of looking at things. So instead of looking at the short-term holder wealth, we look at the total wealth or at the long-term holder wealth. It's a very similar graph. Again, when more than half of the supply is in losses, we want to buy. And of course, now as the price is close to all-time highs, nobody is in losses. But even though the price is so high, the relative ownership of the supply of Bitcoin by the short-term holders is very low. Again, this is not common. Usually during a bull run, when the price is close to all-time highs, the short-term holders tend to take over more and more of the supply. But right now, for whatever reason, traditional media is not interested in promoting Bitcoin. The retail investor isn't yet coming back. And attention is very low on crypto, despite all of that bullishness in the price. Now, if you've been following this channel for a while, you know why the price is up despite the low attention. Usually there is some correlation between attention and price movements, right? When everybody looks at a particular asset, the price of the asset tends to go up simply because so many people might allocate towards it. Right now the price is up, but nobody looks at it. Again, the reason for this is not the masses. The reason for this are the purchases through Wall Street, so the Bitcoin treasury companies and the Bitcoin ETF. In the last 1.5 years, those entities bought roughly 1.1 to 1.2 million Bitcoin. So that's more than 5% of the entire supply. And it continues to grow relatively steadily despite the price going up further, right? So it takes more and more capital to buy the same amount of Bitcoin. This here is denominated in the number of Bitcoin. So if this grows in a linear fashion and the price continues to go up as well, this means that the US dollars that get into the system also grow at the same rate. So if the dynamics are changing that fundamentally, does this mean that we won't see anymore some kind of blow off top, that we accelerate in the rally and then crash back down? Will the institutions just continue accumulating? And is the idea of a Bitcoin bear market something for the past, but not for the future anymore? I'm not so sure about that conclusion, because while it's true that we see constant purchases by those entities and they barely reduce their balance, we have another entity that has more impact. And again, that's the long-term holders. So you see over here in blue, that's the long-term holder supply change. They tend to sell when Bitcoin's price is high. They tend to buy when Bitcoin's price is low. They sold again when it was high. And now, interestingly enough, again, a break in pattern. The long-term holders bought when the Bitcoin price was high, not when it was low. But this seems to suddenly turn around, right? In the last few days, we didn't see the long-term holders buying anymore. But yeah, have a look at how this changes compared to the ETF flows. The ETF flows on average are positive. They do support the price, but the long-term holders are still the stronger force in crypto. If more than 2 million are held by the ETFs and by the Bitcoin treasury companies, that means that there's 18 million that are not held by those entities. And they obviously do have a say as well. And so let's say volatility prevails. What's the potential downside? I always like to look at the reference price of the market, right? What is currently the realized price? Are people currently in profit or in losses? And of course, when Bitcoin is close to the all-time high, everybody is in profit. But by how much? What is the average cost basis? What we see over here is the Bitcoin realized price, and it's currently at $49,000. Roughly. And historically, it was always best to buy when we are below that cost basis. Now, I'm not saying that we're going to crush that orange line in the next week or in the next month. But over time, since this is going up potentially faster than the price, we might again revisit this. And then it's a very good time to get in. Instead of just looking at the realized price in a line like this, we can have a look at the current state in what Bitcoin moved at what particular point in time. And that's what we see here. So at the bottom, we see the Bitcoin price. And on the y-axis, we see the number of Bitcoin that had moved at that price. So that's now the reference price of the market. On average, again, it's at 49K. But really, the story is that the majority of the active supply trades around here, between the 92K mark maybe and the current price. And of course, the people that bought above the current price, they are now in the losses. The rest is all in profit. And so that 92K mark is quite interesting because it coincides with the best moving average for Bitcoin. It's currently at 96, so we are in a similar range. And I've backtested all kinds of moving averages. I tried to find out, if you follow the trend, what's the best SMA. So that's here on the x-axis, the 120-day simple moving average historically works the best. If you trade according to that moving average, you get this kind of performance versus just buying and holding. That's the white line over here. I made several videos on that topic on this channel. channel. If you haven't watched that video yet, feel free to subscribe over here. I will go through this again in more detail in the future. But the TLDR is that if you want to buy whenever the price is above and you want to sell whenever the price is below in order to avoid those bear markets, then the best moving average historically was the 120-day. And so this current trading range is interesting. It somewhat coincides with the reference price of the market as well. And so the idea is when an individual holder is currently in the negatives, say for crypto or for Bitcoin, the tendency to sell is rather low. If you long-term believe in the asset, right? If you buy a house or if you buy Bitcoin, you long-term believe that the asset will appreciate over time. And if you're currently in losses, you tend to just wait it out. You tend to just keep the asset and wait for the recovery. Thus, whenever we are below the reference price, we tend to see less selling pressure and a potential recovery. And that's why historically it was so good to always buy below the realized price. The selling pressure would die down at those points. And it appears as if once we fall below 92K or so, again, most people that at least actively trade might be in the red and might not exit the market anymore. The selling pressure could die down around this area. And so that's then what we are looking at, right? We are in this short-term trading range between our all-time high and the current 120-day simple moving average. The all-time high, by the way, does matter because when we look at the very long-term Bitcoin price and we draw this curved line here, there's nothing scientific about it. Just historically, the curved line connected those price tops very, very well. When we just look at that, then right now we are extremely close to the line. That's why it's so hard to get higher. And that's potentially one of the reasons why some long-term holders stopped accumulating, potentially sell now. Let's see how this develops. Now let's take a step back. There's some interesting news happening with the money supply. The money supply is at all-time highs. And while this is not great for the average person, it is of course good for investors because as there's more dollars floating around, prices tend to go up. Have a look at this chart. You've probably never seen this before. This is Bitcoin relative to the money supply. So we divide the Bitcoin price by USM2 and we've got a curved line over here that interestingly enough connects the bottoms quite well. It gives us an idea of how much Bitcoin could potentially fall right now. The potential risk is somewhere around 60%. I'm not saying that we're going there anytime soon, but it does make sense to have some risk diversifiers in the portfolio as well. Now, besides the monetary expansion, another reason why Bitcoin tends to go up long-term in US dollars is simply because of its shrinking liquid supply. What we see here is the Bitcoin that hasn't moved for the last 5 years. It's almost monotonically increasing. 30% of Bitcoin has not moved over that time period. Thus, the Bitcoin that's available for trading tends to decline over time. On top of that, we've got all of that demand by the Bitcoin ETFs. So that launched in January of 2024 over the course of 1.5 years. 3% of Bitcoin supply got acquired by Wall Street. So roughly an acquisition rate of 2% per year. And so when a lot of Bitcoin doesn't get moved, and that tends to go up over time, at the same time we see purchases by Wall Street through the ETFs, and the token inflation of Bitcoin is rather low with 0.8%. We of course have to appreciate in US dollars long term. The inflation rate of BTC is 0.84%, and in 2028 this will drop to 0.41%. And those kind of effects are the reason why this line goes up over time, despite those crashes we see every now and then. Now, on the face of it, it seems very positive that Wall Street continues to accumulate Bitcoin because they're basically pumping our bags, right? They push up price through their demand. However, the issue is with that acquisition, the correlation of Bitcoin with other risk-on assets also goes up. So now when we see a stock market crash, we are more likely to also see a crash in Bitcoin. And the reason why this is a problem is the valuation of stocks long term. Have a look at this. This is the S&P 500 relative to gold. So this starts in 1885, a very long-term chart with massive volatility. Stocks are historically rather expensive now. And if you go back to an average level in the past, we could easily see an underperformance of 65% or so. Or have a look at the S&P 500 relative to the future earnings. So this is the Shiller price earnings ratio. It's a 7-year moving average of the PE ratio of the S&P 500. Again, a very long-term long-term chart. It starts in 1871. This here is the Great Depression. This here is the dot-com bubble crash. This is the global financial crisis. And again, we are at historical heights. And if you go back to normal levels, we could easily drop by 50 or 60%. Now, why am I suddenly talking about the stock market? It's because things are now intertwined, right? Bitcoin has an influence on all of crypto, and now stocks have an influence on Bitcoin. Actually, when we go back to the very beginning of Bitcoin, how Bitcoin started, the very first block was mined with a message referring this newspaper article. That was an article discussing the bank bailouts. So that was the discussed issue at the time, right? Taxpayers' money is getting used to bail out Wall Street. Bitcoin got launched over here. The very first block was mined in January 2009, at the height of the global financial crisis. So during Bitcoin's history, stocks saw nothing but an appreciation. This is again stocks relative to money supply. But we can look at the same thing with stocks relative to PE or stocks relative to gold. Bitcoin has only seen positive times. The last 16 years had been incredibly bullish for investors. And so that is what worries me to a degree. That's why I want to generate returns as quickly as possible. We don't really know what's going to happen during the next financial crisis. Could Bitcoin potentially fall much more than it has ever done in the past? Could it maybe not just drop 60 or 70%, but maybe again 90% or even more, 95%? Who knows? Again, during Bitcoin's time, we've never really seen a real crisis, a real liquidity crunch. Right now, Wall Street doesn't hold a lot of BTC. Right now they're still in the minority, but as time goes on, they own more and more of the asset and thus have more impact on the price potentially during a crisis. So I'm thinking about this opportunistically. I want to pull out as much capital as possible out of the system before we potentially could see an implosion. I'm not saying it will happen. I'm just saying that in the past we had our massive crises, and these crises could spill over to crypto as well, in magnitudes most people are not anticipating. Now, what you see over here is the long-term performance of these small altcoins, and this is how most people try to benefit from the system. If Bitcoin doesn't grow that quickly anymore and we want to make money fast, let's just buy these small altcoins. But the issue is that most of those altcoins perform very, very poorly, right? This is the performance in the last year. And in the last year, Bitcoin actually went up by more than 60%. So buying those small altcoins is a recipe for disaster as well. But we can do the exact opposite. We can short the altcoins, and we can do this relative to Bitcoin or relative to Ethereum, and then we get a performance like this. The altcoins underperform because all of those insiders are cashing out, right? There's new tokens that get issued, maybe early investors that get vesting unlocks. And because of all of those additional new tokens and because of so many new projects launching all the time, the altcoins on average go down quite quickly. But again, if we bet on them going down, we can make money fairly fast. Here's my P&L over the last 2 months where I traded on falling altcoins. I started with 40K, made now more than 25% return already just in 2 months. And our community is doing the exact same thing, right? The individual trades make very nice returns. But really, it's about the long term. It's about compounding money fast enough. Crypto is very volatile, thus it's high risk. If we've got a lot of risk, we also need the returns. If the returns are only 1 or 2% per month, maybe 10, 20% per year, that's not necessarily enough. Maybe it's okay for Bitcoin, but it's definitely not enough for holding altcoins. My target when doing those relative valuation bets, when betting on falling altcoins, is a performance of 10% per month. Yes, I know this is risk on capital, but again, I'm also hedging this with, for example, buying gold at the same time. So I want to be risk on in crypto, and I want to be risk off outside of crypto so that it balances out over the long term, but still I take advantage of the inefficiencies of the crypto market. Because this is obviously inefficient, right? The market is going down all the time for these small altcoins. So if you want to copy trade me, if you want to learn how to set this all up, how to also properly manage your risks, then feel free to check it out. It's currently $125 per month. A link to premium should pop up directly over here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. Helps the channel grow. See you next time on YouTube or see you in premium. Cheers.